And we continue to count you down to the close here on Bloomberg Television. Kathryn Rooney Vera joining us right now, head of global macro and chief investment strategist over at Bull Tick Capital Markets. Kathryn, always wonderful to see you. A lot of volatility, as I'm sure you've witnessed here over the past few days and few weeks. And I'm curious as to whether you see sort of, I guess, any hope here, any sort of brightness that maybe we're sort of at the tail end of whatever sort of the cycle we're going through right now as the Fed tries to fight inflation and the markets try to adjust to whatever this new normal is going to be.
Well, we're probably at the tail end of the biggest hike the hikes the Fed is going to make. November, they'll likely hike 75 basis points, and then they'll start to trail off. So to that extent, Romaine, I think we are coming to the end of the biggest hikes. But that doesn't mean they're going to stop altogether, and that doesn't mean that we avoid recession. I think, and have for some time, that a smooth landing is more wishful thinking and hoping than reality. And as we know, wishing and hoping, it's not an investment strategy. So what we've been telling clients very concretely is that we are in stagflation, unequivocally moving into recession. And the sectors that perform in recession are the ones that have done great year to date. So stay in those. Those, of course, are the staples and the defensives and energy, utilities, and healthcare. We like them going into the next year. But I'm also starting to like fixed income, and I'm sure Taylor is going to jump in here soon, because that's her area of expertise as well. Yeah. But fixed income is starting to look interesting at these levels, Romaine.
Okay, I will jump in, Kathryn, since you gave me permission to cut off my colleague. What part of fixed income starts to look attractive? Is it full faith and credit, or is it down a little bit into investment grade or high yield?
Yeah, and so high yields and emerging markets are going to see some turmoil. It's part of the cycle. So we're entering into recession, and with high financing conditions and high rates, a lot of the high yields and emerging market names are going to have to restructure. That's part of the cycle, and it hasn't happened yet. So expect difficulties for those below investment and high risk names in terms of complying with their debt obligation. That we think is coming. So where I see value, I think, is more in terms of investment grade bonds. Bonds have had a horrific year this year, the worst that in memory that I have. And I like treasuries even. The 10-year breaking 4% or getting close to 4%. I think that starts to look attractive if you think, as I do, that we are on the precipice of recession. Inflation is likely, as a result, going to drop significantly, potentially towards that 2% target over the next year and a half, bringing yields potentially lower. So in the near term, I think we need to be in short duration investment grade, like you said, full faith and credit, risk-free treasuries. And then over the course of the next 3 months, I'm looking at accumulating duration.
Talk to us about, within this strong dollar environment, whether there's any space to be had in the emerging markets right now. We've got Bloomberg News colleagues who are very keen on your opinion, Kathryn, on the peso, for example, Colombian peso, and whether or not we are likely to see continuing outperformance. But in general, are you daring to dip your toe into EM?
Well, all EM is not created equal, Caroline, as you can imagine. So names like Mexican peso, names like Colombian peso, names that are more closely tied to the commodity cycle, in this case, oil, generally withstand the storm a little bit better. But the strong dollar does take a bite on earnings for the S&P 500. It also does it's not a good thing for emerging markets either. So the Fed in a tightening cycle, the worst thing for emerging markets is U.S. recession, Fed in a tightening cycle, and the dollar strengthening. And I do think the dollar is going to remain strong for a significant period of time because the interest rate differential is so wide and growing. So that's here to stay. Yeah. Within emerging markets, there are tactical opportunities, and those are ones that are more tied to the commodity cycle, oil prices, and that are state-owned entities or quasi-sovereigns. So yes, the answer is yes, but it's not whole hog emerging markets. We have to be very selective in terms of not only EM, not only in terms of regions or countries, but names as well.
When we talk about the strength of the dollar and expectations that it'll continue to sort of remain at these levels, if not even higher here, also baked into that theory is the idea that the other central banks out there will lag the Fed and in some cases maybe even deliberately go in the opposite direction. Do you see anything that can maybe change that trajectory, that maybe they do try to close that gap the best that they can?
Well, the good news for emerging markets, especially in Latin America, Romaine, is that they're ahead of the curve. They started hiking rates a year ahead of the Fed. The Fed probably should have started hiking rates a lot sooner, as we all know, looking backwards now. But LATAM started, and they started a year and a half ago. So they're already there. They're still dealing with imported inflation, that's for sure. But certainly I do think they naturally have the bandwidth to be able to confront the next economic crises. So yes, they can cut rates, to answer your question. And I wouldn't be surprised if the Fed hikes rates to 5%, even a little above 5%, just to give itself that cushion to be able to do something once we're in the next phase of the economic cycle, which is recession.
When we're coming up on some of the quarterly results, the earnings season that is about to kick off and get underway, what are you looking for? What are you hoping to hear from CEOs? Are you looking for a bottoming out in some of the declining earnings that we're seeing?
It all comes down to the labor market. The labor market is still red hot. I think a lot of that has to do with the Fed overextending its accommodative policy and focusing on supporting a labor market that was already doing okay at that point. So the labor market remains, I think, the biggest concerning point for a lot of the real economy. I talked to high net worth individuals that have told me that it's still very difficult to find employees, and those that you find command very high salaries for very little skill set. So that's still, I think, biting into corporate's outlook. The strong dollar that Romaine mentioned, I think, is also going to hurt. My suspicion, Taylor, is that 3Q is not going to see the 2.5%, which is already downwardly revised, earnings growth year on year that the market is expecting. I wouldn't be surprised if we get earnings recession. I think it's intuitive and logical if you consider the amount of headwinds that the economy is currently facing.
Boy, Kathryn, you're thinking of a recession, seeing stagflation, expecting maybe an earnings recession. How hard is it to want to remain in this market at all for some of your clients?
Yeah, I think we get that question a lot, Caroline. Should I liquidate now? Well, probably shouldn't liquidate now, but you should accumulate positions in, for example, fixed income, or if you don't already have defensive sectors, potentially rotate into those from the ones that I've not liked for the entire year, which are the cyclicals, which are the discretionary and the tech names. So certainly there's an opportunity to rotate. I wouldn't be liquidating. I do think it's a very good idea to have a hefty cash position, as well as a position in structured products and alternatives. But certainly I wouldn't be selling into the, potentially close to the bottom of the market. If we get a recession, then multiples could come lower. Equity prices could drop. I do like accumulating once we get the S&P multiple below 14 times. I think that makes sense. But I do think that the market has a little further to run before we start accumulating positions.
Kathryn, great to get your take. Thank you so much, as always. Kathryn Rooney Vera, of course, Head of Global Macro and Chief Investment Strategist for Baltic Capital Markets.